Are you aware that central banks, those boring institutions most people ignore, have been buying gold at the fastest pace since we dropped the gold standard? And here's why that matters to you. Whatever they end up deciding to hold determines how much power the United States has on the world stage, how expensive your imports get, and whether your investments are sitting in the right place. So I spent the last few weeks digging through central banker speeches, World Bank surveys, and IMF data to figure out what's actually happening here, and what I found doesn't match the headlines you're probably seeing. Now, before we get into the details, please note that this video is an educational and analytical discussion of geopolitical and economic events. It reflects my own analysis and opinion based on publicly available information, and does not promote violence, hate, or extremist ideologies. I am not offering investment, legal, or financial advice here. I am simply analyzing how the international monetary system appears to be evolving and sharing my personal conclusions. Let's start with the basics, because I think most explanations skip over the why and jump straight to the what. Reserve assets are what central banks hold to defend their own currency when things go sideways. I've looked at dozens of central bank balance sheets, and the pattern is always the same. They hold a mix of foreign currencies, government bonds, gold, and increasingly, people are talking about digital assets. Here's why they need this stuff. Picture this. You're the Bank of Japan last year, and your currency, the yen, is dropping like a rock. You need to create artificial demand for it fast. So you sell your reserve assets, maybe US government bonds, maybe euros, maybe gold, and use that cash to buy yen. That stabilizes the price and prevents a full-blown crisis. I found this fascinating World Bank survey of 191 central banks that basically asked them, when you're deciding what to hold, what actually matters to you? The answer boiled down to three things: safety, liquidity, and making some money. But here's what most people get wrong about this. Central banks aren't hedge funds trying to maximize returns. They're more like insurance companies. The whole point is to have something you can sell in a panic without causing another panic, and that's where the story gets interesting. After World War II, central banks held over 70% of their assets in gold. By 2010, that had dropped to under 10%. The United States dollar had replaced gold as the go-to reserve asset. Why? Well, I spent a lot of time last week reading through historical IMF reports, and the answer isn't what gold bugs want to hear. The dollar was simply better at the job. It paid interest. You could sell billions of dollars worth without moving the market, and compared to gold, it wasn't very volatile. But now, that trend is reversing. Central banks have bought gold at record levels for 3 straight years. And here's what's really caught my attention. Some central banks are even flirting with the idea of holding Bitcoin. Not many, but the fact that it's being discussed in serious central banking circles at all is kind of mind-blowing when you think about where we were 5 years ago. So what changed? Why would central banks move away from something that works, the dollar, towards something that doesn't pay interest and swings wildly in price? The answer I found isn't about greed or some ideological shift toward hard money. It's about fear, and not the kind of fear you see in market crashes, but a deeper geopolitical fear that the rules of the game are changing. Now, before we get deeper into the strategic reasoning here, and this connects more than you might think, let me mention something I've actually been using lately. If you're watching a video about long-term financial strategy and global power shifts, you're probably someone who thinks about planning ahead. And that includes your own day-to-day sustainability. This is where Mom's Meals comes in. Mom's Meals delivers chef-prepared, ready-to-eat fresh meals designed for convenience, nutrition, and honestly, just making life easier when you're busy. What I appreciate is the variety. They've got keto-friendly meals, diabetic-friendly options, high protein, low carb, low cholesterol, halal, vegetarian meals, and so much more. The meals start from just $7.99 per meal, which, when you factor in the time saved and the nutritional planning done for you, is pretty reasonable. I've put the link in the description, and you can get 50% off your first order if you want to try it. It's one of those things that just fits into the kind of long-term thinking we're talking about here. All right, back to central banks. Let's rank these assets the way a central banker would, not the way a retail investor would. And this is where my analysis started to diverge from the mainstream takes I was reading. The first factor is profitability. Now, most financial commentators stop here and say, obvious, dollars win because they pay interest. And sure, if you're holding US government bonds, you're getting around 4.4% right now. Euro bonds pay about 2.5%. Chinese bonds, 1.7%. Gold costs you about 0.5% to store. Bitcoin pays nothing. But here's what stood out to me when I read the actual central bank research. They explicitly downplay this factor. The World Bank report I mentioned, it shows central bankers rank profitability dead last among their priorities. Why? Because they're not trying to grow wealth, they're trying to preserve optionality in a crisis. An insurance policy doesn't pay you, it costs you. That's the point. That said, the Czech central bank governor made headlines recently by arguing Bitcoin's price appreciation potential could offset its lack of yield. And he's not wrong in theory. If Bitcoin goes up 50%, who cares about a 4% bond yield? But here's where I think that logic breaks down for most central banks. Volatility cuts both ways. If you hold Bitcoin and it drops 50% right when you need to defend your currency, you're not just losing money, you're losing the ability to prevent an economic collapse. That's a risk most central bankers won't take, or at least that's what I concluded after reading through risk management frameworks at the Bank for International Settlements. Which brings us to liquidity, and this is where the analysis gets really interesting. Liquidity has two sides, and almost everyone I read only talked about one: selling liquidity. Can you sell the asset without crashing its price? The dollar wins here, hands down. You can sell $100 billion in US treasuries and the market barely blinks. Try selling $100 billion in Bitcoin and you'd wipe out the entire market cap several times over. Gold is somewhere in the middle. You can sell large amounts, but it takes time and you move the price. But here's the factor nobody talks about: buying liquidity. How easily can you accumulate the asset in the first place? This is where I had a real light bulb moment. Emerging market central banks, the ones driving a lot of this gold buying, don't have massive trade surpluses they can just park in dollars. They need to build reserves gradually. Gold and Bitcoin have a huge weakness here. Their supply is fixed. If Nigeria wants to buy $10 billion in gold, the price goes up before they finish buying. If they want to buy $10 billion, the US Treasury can literally create more bonds to meet that demand. The dollar's flexibility is a feature, not a bug, for countries trying to build reserves. This is why I think the emerging market gold buying we're seeing is so significant. These aren't countries choosing gold because it's better. They're choosing it because they can't get enough dollars without moving the market, or because they're worried those dollars could be frozen. That's a totally different incentive structure. Now we get to safety, which is the most important factor and the most misunderstood. Safety means two things: price stability and geopolitical safety. On price stability, the dollar wins again. Its volatility is tiny compared to gold or Bitcoin. Gold enthusiasts point to its 1,000-year history, but look at the data. Gold had a 30% drawdown in 2013 alone. Bitcoin dropped over 80% in 2022. For a central bank that might need to deploy these reserves during a currency crisis, that kind of volatility is catastrophic. But here's where I need to address the counter argument I keep seeing, because it's a fair point. The writer of the Bitcoin Standard and other hard money advocates argue that as Bitcoin gets more adopted, its volatility will drop. They compare it to gold in the 19th century, saying it was volatile then too. And you know what? That's not a crazy argument. Network effects are real. Volatility does tend to decrease with maturity. But here's why I'm skeptical, and this is my original take. Bitcoin's supply is more fixed than gold's. Gold is constantly being mined, and when prices go up, mining increases. That provides a natural pressure valve. Bitcoin's supply is capped at 21 million, and the issuance schedule is algorithmic. If demand increases permanently, which is what adoption would mean, the price has to go up. And if the price goes up dramatically, you get volatility. I think Bitcoin will always be more volatile than major fiat currencies, which can adjust supply to meet demand. So for central banks, I rate Bitcoin as more likely to remain a speculative addition rather than a core holding. The second aspect of safety is geopolitical, and this is where everything changed. During the Cold War, central banks stored gold in New York and London because they feared Soviet invasion. Belgium and the Netherlands lost gold to the Nazis, so it made sense to park it somewhere safe. The United States built a reputation as a reliable custodian. But then 2022 happened. The United States and its allies froze Russian central bank reserves, about $300 billion worth. Now, forget whatever you think about the morality of that decision. From a purely strategic perspective, this was a seismic event because every central bank governor outside the West looked at that and thought, if they can do it to Russia, they can do it to us. That single action, more than any economic trend, explains the gold buying spree. IMF researchers actually quantified this. They found that both the volume and value of gold reserves increased significantly in the year after a country faces sanctions from the US, UK, Euro area, or Japan. This isn't speculation, it's in the data. Central banks are voting with their vaults, and they're saying gold stored locally feels safer than dollars that can be frozen with a keystroke. Now, does this mean gold is better? No. It means the risk calculation changed. Gold is expensive to store, hard to move, and volatile, but it's physically there. You can touch it. No one can freeze it remotely. For a Russian or Chinese central banker, that matters more than a few percentage points of yield. This brings us to Bitcoin. And here's where I think a lot of analysis gets ahead of itself. The Czech central bank governor's proposal to hold Bitcoin makes sense if you view Bitcoin as digital gold, easier to transfer, impossible to seize if you custody it correctly. And for large institutions moving millions, transaction costs are trivial compared to shipping gold bars. But here's the catch I keep coming back to: custody. If you're a central bank, you can't just hold Bitcoin on a hardware wallet in a vault. You need institutional custody solutions. And we've seen those get hacked. We've seen passwords lost. We've seen exchanges collapse. The BIS, that's the Bank for International Settlements, the central bank for central banks, has been crystal clear in its research. They view Bitcoin's operational risks as unacceptable for reserve management. So where does that leave us? I think Bitcoin gets a lot of media attention because it's new and exciting, but the actual allocation to Bitcoin by central banks will remain tiny for the foreseeable future, maybe 1% of reserves for a few adventurous banks. It might push the price up if it happens, but it won't replace gold, let alone the dollar. Which raises the question I keep asking myself: if not Bitcoin and if gold is imperfect, why not just hold other fiat currencies? The euro, the yuan, the yen, that's exactly what Russia has done. They've shifted from what they call unfriendly currencies to friendly ones, holding more yuan and rupee. But here's my analysis of why that's a limited solution. You're just swapping one geopolitical risk for another. If you're India, are you comfortable holding huge yuan reserves given your border disputes with China? If you're Saudi Arabia, do you want your reserves in euros when European regulators keep talking about climate penalties for oil exporters? The dollar's advantage was that it was relatively apolitical, or at least it seemed that way. That perception is shattered. So let's zoom out and talk about what this actually means for the world, because I think the second order effects are where this gets really interesting. First, what does this mean for the United States? If demand for dollar assets weakens even at the margin, the United States government loses some of its ability to finance deficits cheaply. The U.S. Treasury can borrow at low rates because there's always demand. If central banks start diversifying, even by 5 or 10%, that could raise borrowing costs. Not dramatically overnight, but over a decade, this could mean hundreds of billions in extra interest payments. That means either higher taxes, less spending, or more inflation. None of those are good for American living standards. But, and this is crucial, I don't want to overstate this, the dollar isn't collapsing. The network effects are too strong. When the British pound lost its reserve status, it took over 60 years after the U.S. passed Britain economically. The U.S. economy is still a quarter of global GDP. Its financial markets are the deepest and most liquid. So my base case is not dollar collapse, it's dollar erosion at the margins. But those margins matter. Second, what does this mean for global inflation? Here's a chain of reasoning I worked through. If central banks hold more gold, they hold fewer interest-bearing assets. That means less global demand for bonds. Lower bond demand means higher yields. Higher yields mean tighter financial conditions. Tighter financial conditions mean slower growth. But simultaneously, if countries are less able to defend their currencies with liquid reserves, you could see more currency volatility, which translates to more imported inflation. So we could be looking at a world of higher inflation and lower growth, stagflationary pressure. I'm not saying that's guaranteed, but it's a plausible scenario that depends on how quickly this trend continues. Third, what about individual investors? Look, I'm not a financial advisor, but here's how I'm thinking about this. If central banks are allocating more to gold, that suggests they see persistent geopolitical risk. That doesn't mean you should rush out and buy gold bars. It means you should understand that the era of tranquil, rules-based global finance is probably behind us. Diversification matters more now, not just across asset classes, but across geopolitical blocks. Maybe that means holding some gold, maybe some Bitcoin if you have high risk tolerance, but definitely thinking about currency exposure in a way most retail investors never had to before. Fourth, the fragmentation of the monetary system. We're essentially watching the monetary system fragment in real time, not into a clean, orderly multipolar system, but into a messy network of bilateral arrangements, regional pools, and competing standards. The SWIFT system might face alternatives. The dollar's role in commodity pricing might erode. We're already seeing oil deals priced in yuan. This is the real story. Not what central banks hold, but how what they hold changes what they can do. So where do I think this goes? Let me give you my probabilistic assessment because I think clear-headed predictions are more useful than vague warnings. My base case, 60% probability, is that central banks continue gradually increasing gold allocations by 1 to 2% per year for the next 5 years. Bitcoin gets pilot programs but remains under 1% of global reserves. The dollar remains the dominant reserve currency, but its share of identified reserves drops from around 60% to 55%. This is enough to modestly increase U.S. borrowing costs and gold prices, but not enough to cause systemic disruption. What am I watching for? 3 signals. First, IMF and World Bank policy papers on reserve management guidelines. If they start mentioning gold or digital assets more prominently, that gives cover for smaller central banks to act. Second, BIS settlement data on cross-border payments. If we see a rising share of non-dollar transactions, that confirms fragmentation. Third, central bank gold purchase announcements. Not the totals, but the reasons given. If they start explicitly mentioning sanctions in their public statements, that tells you the fear is becoming institutionalized. Here's my personal takeaway after all this research. The post-Cold War monetary order is over. It didn't end with a bang, but with a series of quiet, rational decisions by risk managers and central banks you've never heard of. That doesn't mean the dollar is finished, but it means we need to stop thinking about reserve currencies as winner-take-all. We're moving toward a more complex, more dangerous, more opportunity-rich system where what you hold and who you trust matters as much as what you earn. And honestly, that makes for a more interesting world. Riskier, yes, but also one where strategic thinking actually pays off. If you found this analysis useful, I'd appreciate it if you subscribe and hit the notification bell. These topics take weeks to research properly, and I want to make sure you see the next one. Share this with anyone who thinks central banks are boring, because what they're doing right now is reshaping the world. Thanks for watching, and I'll see you in the next video.